Hi, not sure if anyone is here yet. It says no viewers, so I guess not. I'll sit here for a little bit and wait. Thanks a lot. I really appreciate this. I do feel better. Still feel awful, but feel a lot better than I did this morning. Well, let's see. Topics today are going to be looking at financing, how we go about IPOs, etc. So I will leave this open and keep talking, and hopefully some people join us. Or at least the classroom joins us, or someone joins us. Maybe. Let's see. Well, there's one viewer. Yay, someone's here. Very good. Hope that's not me. Doesn't count, but you never know. So, just to recap, I do feel a lot better. I'm on some crazy strong anti-malarial stuff, or not anti-nausea stuff. Yeah. Oh, good. We got 3 viewers. So good. Very good. All right. So what we want to do today is talk about IPOs, and we were doing this the other day in class, and we didn't. We very quickly went over it. So let me call this up, and I'm going to share my screen. So here we go. This entire screen, and it'll be great. You'll get to see everything. Or not so great because there's so much going on, but that's all right. So what we were talking about in class the other day was we needed money, and we decided that, oh, good, you guys are on a 101. Very good. So what we were talking about is we need money and the process that we go through to raise capital from the outside and from a public offering. So here's a really cool, much better discussion of than I drew up on the board, but it's the same basic idea. First thing we're going to do is the whatever you want to call it, due diligence and scheduling, tax stuff, et cetera, et cetera. So that becomes early on. Then the documentation, we hire legal counsel, et cetera. Drafting the S1. S1 is the filing that we have to do with the SEC. And again, as you saw before, you file with the SEC and it reviews, and it may take a while. In this particular example, they suggest it's going to take about 4 months. I think it's a little optimistic in some cases, but not awfully optimistic. But I will show you some indicators why I think it's a little optimistic. Marketing, we tell the story, and your elevator pitch story. You do a roadshow presentation. You practice it, you draft it, and that basically is going on the entire time when you're filing with the SEC. And like we showed before, just at the very end of the process, you start your roadshow, dry runs, and then you get out and you actually make the actual roadshow. One thing we are going to talk a little about is that you don't always, in an IPO, and I know in 301 you talk about primary markets and secondary markets. In an IPO, you sort of have both. So for example, let me pull up, let's look at Facebook's IPO. Facebook IPO. And while there were some issues with it, I do think, let me see, the prospectus might be the easiest way. And it is an incredibly long prospectus. Let's look through the Wall Street Journal. I think that's the better one that I've seen. A little easier to read. So here we go, and it's going to take a while to load because it is so long. It is loading. It is loading. I hope. Maybe it's not loading. Patience, 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 patience. Let's call up another one. Let's go to the SEC site. This is, all right, well, that went much faster. Okay, so here we go. First off, notice, talked about the red herring. This is the red information, it's written in red at the top. The information in this prospectus is not complete and may be changed. Neither we nor the selling stockholders may sell these securities until registration statement filed with the SEC is effective. The prospectus, I love this line, is not an offer to sell these securities, and neither we nor the selling stockholders are soliciting offers to buy these securities in any state where the offer or sale is not yet permitted. So, great. This is very early in the process. We don't even tell you the number of shares we're going to sell. We don't tell you the price, etc. But what we will say is who is selling. And if we look at this, what you end up having is that the original owners sell some as well. So there's part of it a secondary offering and part of it an initial share. So some new shares are being created and some existing shares are being sold. This is a prospectus that we in class back in 2012 went through an awful lot because we were talking about, in 402 at the time, we had people do presentations on it and came to the conclusion that it was probably overvalued. Which in fact it turned out to be a little, at least. If you look at the risks here, and just these go on forever, but here's the summary of them. We failed to retain existing users. People get sick of Facebook and leave. We generate substantial majority of our revenue from advertising. The loss of advertising or reduction of spending in advertisers could seriously harm our business. The growth in Facebook through mobile products. They have gotten a lot better at this, but at the time it was very difficult to monetize mobile operating systems, etc. So the fact that it was growing largely in the mobile world turned out to be a very big factor after the fact. It said it here. Don't get me wrong. They said it up front, but it didn't get it all. People still sued them for it. Facebook user growth and engagement on mobile devices depend entirely on effective operation with mobile operating systems, networks, and standards that we do not control. Yay. We may not be successful in our efforts to grow and further monetize the Facebook platform. I think they've done that reasonably well, etc. So other things, loss of key personnel, etc. So there are some of the things that there are problems, potential problems. Actually, this actual one is so early that they don't have the numbers of shares. So here they typically would be Class A shares being sold by us, by selling shareholders, us being the firm. And so you have some of both. You have some primary and some secondary. So let's jump back to this picture. And here's we have, investor targeting, finding size, retail, and pricing decision. It is amazing how difficult pricing an IPO is. Investment bankers are really smart people. We get it. We understand it. They're, highly paid, etc. But it is still very, very difficult to do. And if we need examples of that, let me turn to the head, Jay Ritter. Jay Ritter is a genius. There's just no question about it in my mind. Jay Ritter IPO data. And Jay Ritter, whenever, I don't care, if I see him presenting a paper, I go to it whatever conference I'm at. He is very, very, very good. So let's look at IPO. Let's look at IPO data. We'll start with this. He has an incredible store, a wealth of data here. So one of my favorite ones to look at is looking at tech stock IPOs back in the 90s. Here we go. List of internet IPOs, and we can look at it very quickly, I hope. Let's show what this is doing. It's opening up something. You guys can see all my pictures from West Africa if you want to. I want this open up. Here, let's try this one. Money left on the table. This actually is really good by firm. So, and it's updated reasonably. So these are companies. Now think about this. They left, and what do I mean by leaving money on the table? if your most valuable asset, whatever it may be, think of your car as your most valuable asset, and you say, you know what, my car is worth $10,000, I think. Well, are you going to sell it for $5,000? And that's what's happening. Many of these firms' most valuable asset is the firm. Many of the investors, many of the managers, the most valuable asset is their firm, and they're selling it for way less than they could otherwise. Excuse me. We see a big run up on the first day. So some of the examples, I hope you can see this. Make it a little bigger, I hope. Let me just jump over and pull up this window. And if you guys could possibly let me know, can you see this? Maybe someone text me or something. Is this visible for you? I'm going. Yeah, I'm not sure yet, but I'm going to go with this is. So here we have Visa, for instance, left $5 billion on the table. UPS left $1.6 billion. Twitter, $1.3 billion. Palm Technologies, which is a fascinating case, which we'll talk about in a few minutes. Palm Technology left $1.3 billion, et cetera, et cetera, et cetera. So we're leaving an enormous amount of money on the table. And the other way to look at this is the closing price at the end of the day. For example, let's look at Corvus. And Corvus went public in 2000. They sold for their first price was 36. Their offer price was 36. At the end of the day, they were trading at 84. And it's too small. Okay, so let's make it a little bigger. Okay, so here we have, just to repeat, since you couldn't see it, Visa, UPS, Corvus, etc. The amount of money left on the table, $5 billion. Think about that for a second. The IPO date, they went public in 2008 in March 19th of 2008. The original price was 44. They closed at 56. So if you take that $12 and you multiply it by the number of shares, in this case 406 million, you get the amount that they left on the table. So it's closing market price less beginning market price. So, and what is interesting, and we'll see in a few minutes that the theories behind this, one of the theories is that, well, it's just investment bankers taking advantage of people who don't know any better. Goldman Sachs is on the list. Goldman Sachs left almost $1 billion sitting on the table when they went public in '99. So it's not, it's really tough to figure out the rhyme or reason why these companies are doing it. There's other ways to look at this as well. So let's jump back and let's look at biggest run-ups. This is not necessarily the most most overall capital left, but this is the biggest percentage that we mispriced things by. So this is from 1975 to 2014. And for instance, in 1980, October 14th, make this just one more click bigger, Genentech went public. Their first price was $35 a share. At the end of the day, they were trading at $71 a share. So they literally doubled. It's just hard to comprehend that we could be that wrong in pricing things. So we're not that wrong all that much. If you look, it happened once in 1980, and this is in time order. So 1980 it happened once. 1983 it happened 3 times. So in other words, it didn't happen in 81 and 82 at all. Didn't happen in 84 and 85 at all. Happened 3 more times in 86. Then it didn't happen again until 92, where we saw a doubling in stock price. Boston Chicken, it happened, and that was an interesting one. We'll come back and talk a little about that one in a few minutes, but just it's worth noting. This is Boston Market. You're probably familiar with, the restaurant chain. Here they went public at 20, and they ended the day at 48.50, etc. And I'm not going to get into all of them. People are texting me, and okay, there we go. So here we have other companies that went public, and what is interesting is looking at the year. 92 there was one, 93 there was one, 94 there was one, 95 there was 1, 2, 3, 4, 5, 6, 7, 8, 9. So bigger number. Some of them you've probably heard of. Netscape, I'm guessing you still have heard of. Citrix. Citrix is the company that makes GoToMeeting, so they're still around. Some of these companies have gone out of business. Some of them have not. In 96, there were some more. Yahoo, which you've heard of. Edify Open Market, Great Plains Software, etc. In 98, Broadcom went public. Some of you may know why that's famous. Broadcom broadcast actually is the same. They look at their price. They went price public at 18. At the end of the day, they were trading at 62, almost $63 a share. Who owned Broadcast? And I'm not going to tell you. Yeah, well, why not? Broadcast. Someone you've heard of? IPO. And here we go. Hopefully this will come up quickly. And if you can see that, I'll make it bigger for you. Many of you have seen on NBA basketball games and other things. It was Mark Cuban. So when he went public, he, of all people who knew, he was very, very smart, everyone says, he left an awful lot of money on the table. His stock went from 24 to 53 in that first day of trading. In other words, just think about what we're saying. Most valuable asset, your car, sells for half price. So in this case, 2,400 when it was worth 5,300. I mean, it's just tough to imagine. Or, sorry, 1,800 when it was worth 6,200. Wrong broadcast. eBay was on the list. And again, look how many there were in 1998. So we're seeing this growing, this becoming more and more popular, or more and more common. Some of these companies are still around. Some of them have been bought out. Broadcast got bought out. eBay still around. So they back-to-back, really no rhyme or reason. Zoom is still around. I thought Zoom, this one down here, had gone out of business until about this time last year when BondResponse started sending money over to the Philippines, and I realized that was one of the main ways to send money to the Philippines. So we ended up using Zoom, and like I said, I didn't know they were still around. Which brings us to 1999. In 1999, of all the bubbles that it is just incredibly difficult to describe. So let's look first at the number of happened in 1999. And I hope you guys can see this because I'm not going to be able to count this many. This starts here. And all of these are 1999. 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 So still going back into 2000 now. The internet peak, if you want to think of it, happened in 2000. So in March of 2000, they hit. But for a while, IPOs were still popular. So if you look at 99 and 2000, you have the vast majority of our sample. To the point where, from that point on, from Transmeta in November of 2000, there was not another IPO that doubled in value until 2004. And then we had a few. We had Jet Oil, 2004 and 1. Then we had Chipotle, 2006, LinkedIn, 2011. Again, 5 years later. Sprouts Market, a stock that we used to own in Sim for a while, etc. So all of these, and you're seeing they're back to not common by any stretch, but not unheard of either in so far in 2014. So that's a big problem. We are leaving so much money on the table, and we are mispricing things by so much. What, how, why, etc. So we want to look at underpricing, and we want to see, maybe if we can control it. I will say that we leave money on the table everywhere. It's not just the United States. Let's look, and I hope this is the right one. Here we have a study looking at different countries, and make it bigger. I'm learning this online format. There we go. Hopefully. You can see both? Yes. So what is interesting about this? One, we have, all different countries, A, B, C, etc. We have the sample size, we have the time period, and we have the amount of return first day, average first day from offer price to end of day price. And we see, all positive, some very, very positive. For instance, if you're looking at China, the average return from 1990 to 2013, the average return has been 118%. And we can talk a little about that in a few minutes, but everywhere is positive. And if you would imagine that if this were fairly priced, it's not an absolute guarantee you're not going to make money. And it appears, while not a guarantee, it sure looks like a pretty good investment. If someone offers you a chance to buy into an IPO, you probably want to do it. And again, all different types of countries, different, United States is here just about 17% through 2013. And it varies depending on how far back, but 17% is a pretty big number. If you think about the average return on a stock, if for S&P 500, the average stock return is 12% for a year. We're talking 16, 17% on one day. So something is going on that makes this first day very unusual. And why is it so difficult to price? So, and I don't know if we want to look at other. I mean, there's more of these looking at first year in different countries, but we saw the summary of them, and I'm fine with that. If you are interested, I will put this. You can see the link here. Just search Jay Ritter, Jay Ritter IPO data, and play with it. There is an awful lot of very interesting stuff. Whether you're looking at the Excel data or whatever, I'm not gonna. Let's just save this here. And we just saved it in the middle of, it's all right. This is looking at who was the person that took it public, and the different. I'm gonna have, I think, company coming. This isn't necessarily good. My dad's walking in the door, I think. But here you have who was the underwriter that took the company public. And I will say, for example, you guys can't see this. I will learn. Maybe I will learn. I'm clicking the wrong thing. Here we go. It's a little better. And oh, here we go. View. Let's go to 150%. Hopefully you can see it. The end result is going to be that most of the time, the underpricing is a little less if you are a high-rated firm, if you are a high-rated investment banker, which makes some sense if you think about it. If you are paying for whatever you want to call it to reduce the information asymmetry, we're going to get some hopeful reduction from that. So, all right. Anyways, that it's tough to follow in that format, so we will leave that. Just trust me on it for most of the time. And it flipped in '99 and 2000, which we will talk about again in a little bit. So what we basically concluded is stock markets, IPOs in stock markets, no matter whether it's in the United States, China, wherever, go up dramatically on the first day of trading, and it's very tough to do. Okay, I'm gonna just text my dad and say that I can't come to the door. I am in the middle of a class. Sorry. So what we have, looking, this one is valuable enough to look at, and I think this is the summary of everything. So if you're going to look at only one file, it's probably going to be this one. Highly recommended. Highly, highly, highly recommended. Make it bigger. And I'm going to go to 150%. I'm going to go bigger. I'm going to go to 200%. Just to read the format. So what we have, this is the month, January, February, March, April, etc. This is the year, 1960. Well, someone's coming anyways. Hi, I'm in the middle of a class. So I'm in the middle of a class, but hi, thank you. Okay. You want to see my dad? He just walked in. You can see how this works as well. You want to come on over? You can say hi to my class. Let me see. I'm sharing screen. Let me end the share screen. And here you go. There's my dad.
Hello.
So he's just bringing over some Gatorade and ginger ale. So very welcome, I might add, because I have lost a lot of fluids this morning. So anyways, not to get off on a tangent, but thank you very much for bringing that. Can I have one now?
Yeah.
One of anything? I don't care. I'm really thirsty. So when we're looking at IPO data, let's go. Let's share everything. Share entire screen. What we're going to see in this information is if we're looking at January, February, March, etc. If you go through this whole thing, the average is going to be the 17% number we said. The other thing that I think is really interesting is, oh, thank you so much. I never knew I liked Canada Dry ginger ale so much. This will be a commercial for Canada Dry.
I can tell you another thing you wanted interesting. You only got one of them and one of these. I can bring more of these and more of these.
Okay. 2 liter price was more. This is going on for 2 hours, so
Both
like
the same.
same price.
Same
2 liter and 20 ounce cost the same amount. So
to the penny. $1.99 plus deposit.
So, anyways, if we're looking at this last column, okay, not right now. All right. So this last column, please don't put it in the fridge. I don't want it cold though. This last column is very, very skewed data. So obviously you can't go less than 0 for starters. That's part of it. But then also look at, when markets are hot, following hot periods. Can you step just outside? Well, I guess not. We have, after a period of high returns, let me show you an example. In the 1980s, IPO returns went up. Notice 1980, Reagan came into office after a time period when the economy was really very poor in the late 70s. Stagflation was in place, etc. So we had virtually no IPOs going on. Then all of a sudden, this column as well, very few IPOs. And then all of a sudden, there was an explosion because there were a few good periods, 119% for 8 companies that went public. If you want to go out, I always think of it as 9 months. 9 months works real well. Just, you think birth of a firm. We have, by the time we do the due diligence, by the time we decide, we want to go public. Lagging really bad on our end. Okay. I will slow down. Yeah, we have a data problem, a broadband problem at school. How about now? Can you hear me a little better? Hopefully it catches up. As I was saying, if you look in this period where returns were high, 73, 119% for January and February of 1980, you go ahead about 11 months, and
You want more later?
I have no idea. I'm probably good. Okay.
I'll be in over later today.
Okay. Thank you very much.
Take care.
If you jump ahead, you see the return. After this period of very few IPOs, you see the number of IPOs jump. In this case, it went from 8 to what's the highest we see in this period? 56 in the next year. So 62 actually in the next year. So there is a lead lag relationship. High IPO prices, lots of people copy it because they want in on the deal, and they try to sell theirs as well. Continuing on, and I'm going to jump ahead to 1990s. Late 90s to show you how incredible this got. Look at these average returns. 98, 163% for 7 firms. Jump ahead, you have 60 firms, 55 firms throughout the next next year basically. Anytime you put something with IPO or internet on it, .com, it went very, very well. Prices went up fairly dramatically. After 9/11, it is interesting to see the market basically shut down. So let's see, here we go. This is, make sure I get the year right. So this is, bye, thank you, sorry. This is September of 2001, during 9/11. There were no IPOs that year, or that month. There was only one for, no, I'm sorry. There were no IPOs that month. There were 7 the next, 9 the next, etc. So we went into a period of very, very few IPOs. We see the same thing when we jump ahead. Look at after the market collapse, if you will, the number of IPOs during during the financial meltdown was 0 again, which we hadn't seen in quite a while. And to this day, they have never really rebounded in the number that we used to see. There's lots of debates on why that is true. It might be the case that we have Sarbanes-Oxley, et cetera. The cost of being a public firm has gone up fairly dramatically. And if you are a public firm, why, if you're a firm already, and if there's now private investors that are willing to, fund you and keep you afloat without having to go public, you might want to do that. So that is some of, I love this. I mean, I literally, if I were in class, I would say, you guys play with this for a while. It's really, really cool data. Jay Ritter, again, this is IPOall.xls. IPO. So, all right. One interesting thing, if you want to, and I'm not going to do it because I don't want to, you guys are having a tough time following me, is take the average of this period, of this whole column, and that's what you're going to see where the 17% number turns out to be. So, all right. So why do we have underpricing? Underpricing is very pronounced. I've shown that over and over and over again in multiple ways, in multiple formats. We know it exists, but we don't know why it exists. So let's go back over here and let's give you some theories on why IPO underpricing exists. So maybe I will write this out, so if you can't hear me, it might help. So let me just go to drive.google.com, and we will create a new file, a new Google document. And I will label this IPO underpricing hypotheses. In other words, why does IPO underpricing exist? So there we go. So here we have why IPO underpricing exists, and I am going to give you a couple, and more than a couple. I'll give you quite a few different theories. Let me Control A, and let me make this bigger so you can all read it. I'm guessing 24 font should work. So potential explanations, and there's no absolute right one here. Potential explanations for IPO underpricing. Okay, so now we'll go. Number one, we suggested, is that investment banks are taking advantage of firms. Oh, if you think about this, the idea is that investment banks take companies public all the time. They know how to do it. They know what's going to sell well, what's going to sell poorly, and they take advantage of it. There's a problem with this. First of all, it doesn't fit the data very well, at least in the aggregate. It happens to IPOs of not just investment banking, of not just non-investment banking, but investment banking firms as well are underpriced. We saw that with the case of Goldman Sachs. So yeah, maybe there's a famous paper by, real quickly, Mascarella and Vetsupins. Oh, how about I spell Vetsupins right? Here we go. And let me do, again, IPO. There we go. And actually, this isn't their paper. This is quoting their paper. Well, I will look for it. But the basic idea of their paper was that underpricing happens whether or not it is IPO 1989. Well, I can't find it, but what they find is that IPOs are underpriced regardless of whether they're an investment bank or not an investment bank. So this theory sort of goes out the window to a degree. There's another problem here. Let's suppose you are selling your car, like we talked about before, and there's two places to sell your car in town. Place one has a reputation of underpricing cars, so they will sell a car that's worth 10,000. They will sell it for 5,000. Place B will sell a car that's worth 10,000. They will sell it for 10,000. So there's a problem, because while everyone would want to buy from the place that is underselling cars, right? Who wouldn't want to buy a 10,000 car for half price? Very quickly, that dealership or that used car salesperson is going to run out of cars to sell. No one would come to them and say, you know what, let's go ahead and underprice my car a lot. So there's a theoretical issue here that is a problem that we have to talk about, and we will in a few minutes. Other theories here is that there's a threat of a lawsuit, and this is related to the first one. This is related to number one. If we're looking at a threat of a lawsuit, who's going to sue us? And it's not going to be companies that go up in value. Stockholders are not going to be like, oh my goodness, I hate it when I make so much money. They are going to sue when they lose money. So consequently, what they see, that's why we see, pages and pages and pages of risk analysis in the prospectus. Also, we see the idea that we are going to underprice to prevent having a lawsuit. Now, I guess I should put in here, we'll tab in. This is lawsuit by investors, because there's two parties that could be suing. The second one would be lawsuit from whom? Think for a second. Correct, the firm. So we would have a lawsuit by the firm if there were too underpriced. That's a problem, because we don't see that. We see some evidence, relatively convincing evidence for the first one, lawsuit by the firm. We saw that, if you are going to sue someone, who are you going to sue? Well, you're going to sue big firms. It doesn't make sense, to go through all this rigmarole for a small firm. So consequently, there have been studies that have looked at the relationship between underpricing and firm size, and they find that there's a positive relationship. Bigger firms are more underpriced because they have deeper pockets. If on the other end, lawsuits from the firm is an interesting arena. At least I find it so, because I almost made my dissertation on it. What I was looking at was it was after Boston Market, and I had originally looking at it because I thought this lawsuit thing was something. So I'm looking through the data, and I found one company threatened to sue for underpricing. So this B here was one company, and it was Boston Chicken. And so I figured, well, gee, this is great. I'm going to write about why they sued and other firms didn't. And I called their investment relations up, and I, tried to get the data. I couldn't find a lot online, et cetera, et cetera. And they said, oh, we dropped this lawsuit. We decided not to go against it. So there wasn't much around to go by on that. That did change, by the way, just for completeness. That did change after the internet bubble. The lawsuit was not brought necessarily by the firm, but the lawsuit was brought by the firm's creditors. And if you want to imagine why, the basic idea was that because you underpriced our stock, we didn't have as much money as we should have had. Because we didn't have as much money as we should have had, we ended up going out of business. So therefore, it's your fault. It didn't work real well. And I think 2A is still much more important than B or C. I'm not saying, it won't happen, but A happens much, 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 much more than B and C combined. So that's one theory that goes here. And another theory, let me bring this out. Decrease indent. So another theory of why IPOs are underpriced is that there's, how to put this nicely, finance professors are idiots. Let's just call it what am I going to call it? Market stabilization. So market stabilization is one of those things that doesn't seem, if I could spell it would even be better. Market stabilization doesn't seem like it should be legal. It is based on the idea that we have syndicates. So the syndicate can go into the secondary market. and keep price up until and after actually until whole issue sells, and then usually for 30 days afterwards and some period of time afterwards. So first off, I think it is worthy to talk about why this happened, why this came about. Came about as a direct, it sounds like it should be illegal, I think, but it comes about as a result of the Civil War, the U.S. Civil War. And what was going on was that they were, the North, in some period this is, can't spell and write talk at the same time. After. So in the Civil War, the North needed tons of money. I mean, if you look at the size of the federal government before and then during the war, the amount of spending grew exponentially. So they needed to raise money, and they decided the way we were going to do that was we were going to sell not just in Philadelphia and New York, but we were going to sell bonds, U.S. bonds, everywhere. Think of them as war bonds, think of them as whatever. We were going to sell them everywhere. So consequently, when we were doing this, there were people in small towns. You can think of it, Buffalo as a relatively small town at the time, being afraid that they didn't have the up-to-date information. So we formed a syndicate, and there's big investment bankers from New York and Philadelphia and Washington who have all the inside information. The people outside in Columbus, Ohio, or Buffalo, New York, or wherever, California, didn't have that information during the war. And they were afraid that they were going to be left holding the bag. So what the syndicate did was say, okay, until you sell your whole issue, we will go and we'll prop up the price. So I think it makes a lot of sense. Let me explain it real fast. Let's suppose we know now we want to be in an IPO. We understand IPOs work really well. First day trading, if someone says, hey, do you want to buy into an IPO? You want to say yes. That's your default answer. Even if you don't know for sure who it is, your default answer is probably yes. So what happens if, let's suppose we do this, we get a phone call from our broker and says, hey, we would like you, do you want to buy into an IPO? And you say, yeah, sure. And they give you the information, yada, yada, yada. And you put in for 100 shares. Great, phenomenal. Problem. Everyone else, there's differences of ability in picking IPOs. We buy it blind. Most individual investors don't really have the ability, research time, etc., to really dive into these. For years, they were not allowed to participate in road shows, etc. One second, excuse me. Proving why this is a good idea that I'm here, not in school. It was a very common to see that when companies went public, if they did poorly, the syndicate went in and stabilized prices. So let's imagine a story that there are some times that they're undervaluated, and we have lots of people wanting to buy. So both the institutions want to buy and the individuals want to buy. So we can do this in a different way as well. We can say keep the little guy in little investor, we should say, more politically correct. Keep the little investor in the game. And I'm going to develop this a little more here. Let's suppose individuals are at a competitive disadvantage. And Bonnie says hello. Disadvantage to institutions. And we see that seems to be true. Institutions do buy more in, quote, good IPOs than in bad IPOs. They buy into both, in part to keep the other side happy, but they do buy into both, but their percentage is much higher in a good or a hot IPO. So what happens in a bad IPO? Imagine an overpriced IPO. There's two things that are going to go on. One, it's going to be tough to sell. And you can think about why that is going to be tough to sell is because that the institutional investor, does not want many shares. So what do we have to do? We have to get more individuals into these bad IPOs, these overpriced IPOs. So what happens, you get a phone call or you email or whatever, hey, would you like to participate in XYZ company's IPO? You say yes, put in for 100 shares. A couple hours later, it hasn't sold yet. They're still trying to sell it. They call you back and you say, hey, or they say, would you like to buy some more shares? Can I have a couple additional shares if you're interested? And at that point, you should say no. No, 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 no. I do not want them. Why? And it's really awkward to sit here and say why and not see anyone's face. So I'm just going to say, I'll give you the answer pretty quickly. Reason being that if the only time that people aren't going to be buying this quickly is when institutions decide not to play. Institutions have a better market, better information. So if they're not playing, it's probably an overpriced IPO. So what you are going to do is not buy anymore. And in fact, you're going to sell what you've already sold. You already bought. So you bought some in the offer. You're going to go and you're going to sell them in the secondary market. So what happens now? Well, you sell them in the secondary market. The price is going to drop. And suddenly the syndicate is stuck trying to sell shares at 20 when in fact the price is now 18 in the secondary market. Now, I don't know what college you want to pick on. I typically use Canisius as the example, but what do you do at this point? If you're trying to sell shares, what do you possibly do? And I mean, as a joke, but you have to go and you have to be friends with Canisius alumni office and you have to get their names and then you call all of them up and say, hey, would you like to buy a stock it's selling an 18 in the secondary market, but would you like to pay me 20 for it? And clearly you're going to run out of names pretty quickly that want to do that. And obviously for legal purposes, you're not really going to call Canisius because Canisius is a great school. But anyways, you get the idea. So what happens? Well, when you can't sell the shares, you as an investor start to sell. When me as an investment banker can't sell the shares, you start to sell your shares. What I am going to have to do, and the syndicate is going to have to do, is go into the secondary market and artificially prop up the price. And when we prop up the price, we're losing the lower tail of the distribution. So let's imagine for a time being that we price things on average correctly, but we now truncate the bottom. And all of a sudden, it looks like stocks are much overpriced or much underpriced, when in fact, maybe some of the time we don't underprice things as much. Okay, so that's a tough one to follow. There's two things. There's A and B here, and it's an important one. So if you don't understand it, think about it. Come back, ask me next class, etc. But that is an important area. All right. So next thing. 4. I'm going to call it bribery, and clearly a very strong word. So let's suppose, just for argument's sake, we go back to this case up above where investment bankers are taking advantage of firms. And the problem becomes that they're going to run out of firms to take public. Well, if they can bribe you, it might work. So this comes out, by the way, this comes out of numerous cases, including Bernie Ebbers at WorldCom. And what we found, Bernie Ebbers, WorldCom went bankrupt, and they ended up looking at his trades. And what they found was that he was invested in all of the hot IPOs. Virtually every hot IPO, just make sure you guys are still in. Yep. All of the hot IPOs, he was there. It was either he was a great investor or something else was happening. So Bernie Ebbers was CEO of WorldCom, and WorldCom was growing almost completely by whatever you want to call it, by taking over companies. So they were doing lots and lots of share issuances and lots of debt issues. So what was going on was, as an investment bank, I want them to participate with me. I want them to pick me as an investment banker. Or in the car example, I want a car to sell. So now let's go back to the car example and explain what happens and be thinking car, but then we're going to apply it for stock as well. So let's suppose that you have a $10,000 car to sell. And we have two, just like before. We have a company that sells them for underpricing, and we have a company that sells them at a fair price. Clearly, you would take it to the fair price. But what if now, and you're busy, you don't have time to do that. So instead of doing it yourself, you hire someone to take it public. Or to sell the car. Much like shareholders hire managers to take the company public in a way. So what may be going on, and I think there's a lot of evidence of that, is that we are bribing managers by letting them in on hot IPOs. It has been used as an explanation of why the returns are so high in, China, for instance. China, the returns are maybe very high. I'm not going to start a international trade thing here, but it has been suggested by others that what's going on is who buys into IPOs there, and it's corporate officials. It's government officials. So if government officials are getting a big deal, I mean, hey, wow, this is great, yay us. We can also see this, and this I'm not going to show it because I've learned my lesson on showing trademarked IPO 60 minutes. Actually, let's do it like this. Congress Insider Trading 60 minutes. And right here. Well, all I'm going to do is put the link in this for you guys, and I'm not going to play it, but it is a great case where you see maybe I'm not again not accusing at all, but at least something consistent with this idea that we are maybe bribing officials, maybe bribing companies, etc. If we are, and personally, I think at the margin we probably are, whether intentionally or unintentionally, that gets around the problem of running out of cars to sell, running out of firms to sell, because we're paying them money to come with us. Clearly, we can't write a check to them because that would be illegal. We can't write $1 million check. But if we say, hey, buy this IPO and it goes up by $1 million, well, it looks a whole lot like a bribe, and it may act like a bribe. So anyways, so that is something that we really want to focus on, or really want to think about long and hard. That's one explanation of the IPO underpricing. Another one is that finance professors are idiots. And obviously, in the case of myself, you can prove this pretty well. But overall, I think you will see that, maybe, and that's clearly and a joke. I don't want to hear from finance professors, which I have in the past, by the way, saying, why do you call us idiots? Well, you're not idiots. We make mistakes. Think of this as mismeasurement. Mismeasurement. Isn't that how you spell mismeasurement? Maybe not. There we go. Mismeasurement. And let me give you an example. And this will be the Palm 3Com example. And this comes from Jordan and Ritter. Jordan, I think it's Jordan and Ritter paper that looked at this. But what I'm going to do a search for is a review of that paper by myself and Rodney Paul. And we hit it very well in a football paper, Football and Finance. So using football to teach finance back from, wow, man, time flies. It was a decade ago. And here we go. It's a sort of a cool paper if you want to read it, look at IPOs, look at other things. Probably a little easy for most of you guys, but it's not bad. It's really not too bad as examples. So tickets, scalping, and price and float. So in March, here we are. In March, and you guys can't see that, so I'll make it bigger and bigger and bigger. In March 2000, 3Com sold 5% of its Palm Technologies through an IPO. So they owned the rest of the firm. They sold off 5% of it. It was very widely accepted. It was very hot. Palm was think of it as sort of a scheduler, first calendar smartphone type thing. Although I don't think you could talk on it. I'm 99% sure you couldn't. So went up a lot. So at the end of the day, Palm, which, and you hear ambulances or police cars going by, Palm had a market capitalization of, where was it? $45 billion. So enormous capitalization. And what that is shares outstanding times stock price. So $45 billion. Now, revenues were projected at $1 billion. So, I mean, EBITDA multiples, whatever you want to call it, were really, really high. 3Com, on the other, which, by the way, owned the rest of it, right? They owned the rest of Palm. So you would think they would be a lot bigger, actually had a market capitalization of only $29 billion. So doesn't make any sense. It's seeming, and this got all kinds of people reporting on it, saying, markets can't add, subtract, et cetera, et cetera, et cetera. So what was going on here? So let me take you to Ralph Wilson Stadium, or better yet, let me take you to the Sabres up. We'll go to Harborside, and in it, somehow, and this could be the most amazing thing of all time, but the Sabres get to the Stanley Cup. And we'll argue, say, just for math purposes, let's say there's 20,000 people at the game. And let's imagine a case where you are in charge of figuring out how much revenue came for the game. So how much revenue? So you just ticket revenue, not looking at anything else. So how would you do that? And I will let you think about it for a bit. I'm guessing the accountants in the room are probably writing this down really quickly, and you have a good way to price it. Okay, that's not how finance professors would do it. Right? What we did, and we do consistently, is take the last trading price, not what they paid, but the last trading price. So back to the Sabres and see why this is such an awful scenario. Lots of people are buying tickets. They're paying, it's a Stanley Cup, Game 7 in Buffalo. Clearly a lot of demand for it. So let's suppose they're paying, I don't care, $500 a ticket, and $1,000 a tickets in the 100 levels, and whatever. You can figure out your prices. Just as the game is about to begin, there's a scalper still outside. There's a big line of people wanting to get in. There's one ticket left. And he's saying, who wants to buy this ticket? And everyone is screaming and bidding up the price and bidding up the price. I can imagine that ticket selling for $10,000. So if, in fact, it sells for $10,000, would you then say, whoa, let's go? So last price, $20,000 times, last price, $1,000 times whatever the number was of people in the stadium, 20,000. Would you take 20,000 times 1,000 and say, okay, that's how many people, that's how much revenue we got for the game? And no, you wouldn't, of course. It's the last trade, and that's all it is. But that's how we do it in finance. That's how we did it, the last trade. So there's a big difference between last trade and actual price when it comes to hockey tickets. Is there when it comes to stock markets? Now, in theory, no. In theory, you should be able to, the number of shares outstanding is a good approximation, et cetera, et cetera. But many times there's such thing as float. And what float is the number of shares that are actually traded outside of the firm. So like I own some, I work for the firm. It's a share. My shares I own are outstanding. But since I work for the firm, they're not included. I'm holding on to them. I'm not selling in the IPO. So what happens is generally a very small percentage of shares are actually traded. The float is much less than the number of shares outstanding. Think of it in the hockey example. The number of tickets that the scalper has to sell is a lot less than the total number of tickets sold in total. So what happens here is that we end up with a mispricing. And it's tough to get at because we don't know, how long that mispricing is going to happen. There is what's called a lockup period. Lockup period. And the lockup period in the United States is generally 180 days, usually. And what that is the time period when the insiders cannot sell for, right? So they have two choices. Insiders can sell at the IPO, or they can sell after 180 days, but they're not allowed to sell during the first 180 days. Do you have any idea why? Basic idea is that if you are going to lie, cheat, or steal, hopefully after 180 days, it's going to be found out. And consequently, you can't game the system and say, oh, everything is great, buy my IPO, have it go way up in value, and then, sell the next day. You can't do that because sometime in the next 180 days, it's expected that that would be found out. So what do you think happens? And yes, sure enough, long-term performance of IPOs. Long-term performance of IPOs is actually negative. So we're looking at two different issues now. We have a short-term underpricing and a long-term overpricing going on at the same time. And lots of people have looked at this and why. And I mean, there's behavioral stories that, I want to buy in it because it's really exciting to buy an IPO and I'm willing to give up some return in order to buy that. On the other hand, maybe it's not such, it's not a market imperfection. Maybe it's that if you think about what you're buying when you buy an IPO, you're buying shares in place and you're buying a real option on the firm itself, the growth option, if you will. So at the IPO date, uncertainty is very high. So volatility is very high if you want to think about it. And if you're buying a real option, if you think about option pricing, that option is going to have the most value where uncertainty is the greatest. So consequently, over time, over the next 3 years in general, which is what the long-term studies usually look at, that resolves itself. That uncertainty resolves itself. So the value of that option drops over time. So we don't have as good of explanation of why there is this long-term overpricing, but we have some theories, and I think that for a 401 class we're good at if we just know the theories. We'll probably do a couple IPO cases in 402 that you can look at, and you can say, okay, well, here's an example of market being overly optimistic. Here's an example of real options actually coming into play. So this idea is, this idea that we have underpricing in the short run, overpricing in the long run has been sort of at the front of the IPO literature for decades. I think we are getting it resolved a little. I think that the idea that there's some, if we don't want to call it bribery going on, at least favoritism maybe going on. And again, I would recommend you watch the 60-minute piece. It is good. At the same token, I think there's more stuff going on. I think that information asymmetries matter a lot. And if you, again, think about this for a second, these IPOs are risky. And long-term, they drop in many cases. So in fact, in many cases, they drop long-term. So I am asking you as an investor to do a lot of research on this. And the research on an IPO is significantly more than on the research for another company because there's no track record. There's no way to see how it trades, et cetera. So you have to do a lot more digging. And I'm going to have to pay you to do that digging. And one way I'm going to pay you is with a higher return. The other thing that happens here is we're seeing one side of the market. And we don't have shares to short. So in an era when, if we have a very skewed distribution, we see the people who are optimistic, we don't see the people who are pessimistic, we are going to see overpricing in the short run. Over time, that resolves itself and it comes back down to a more long-term normal return. So, all right, so that's pretty much it for IPOs. Seasoned equity offers. Let's just talk briefly on seasoned equity offers. Here, what this is, so we're selling shares. How about if I make this 2 words? Selling shares when shares are already traded, when shares are already publicly traded. Oh, I forgot something. Let me come back up here. There's one other version here. I forgot all about this. This is number 6. So 6. And it's a marketing story. I don't know how I forgot that because it's going to come into play first thing when we're doing season equity off. So marketing story. And there's 2 types of marketing it could be. It could be product marketing, and it could be investor marketing. So who are we marketing to? It's very difficult to do marketing studies. Let me start by saying that they're long term. The math behind them gets really difficult really quickly because you have so many confounding variables, and it's pretty tough to do. So it might be the case that we wanted to cut through that, and we're willing to lose a lot of money to get people to talk about the company. So for instance, here we are, what is it, 21 years after Boston Market went public, talking about Boston Market in the classroom. If Boston Market had come to me and said, hey, will you talk about my company in public, in the classroom, the answer would probably be no. But here we are doing it for free. And that idea is, you're buying advertising. Seems to me to be a very expensive way to buy it. I mean, we're losing billions of dollars to get for an ad campaign. Maybe, I don't know. The second type of marketing is investor marketing. And in this, what we're doing is we're saying, I am going to underprice because everyone, the Wall Street Journal, CNBC, investors in general, all have heard of our name. And if we hear of our name, it's going to be, there's thousands and thousands of companies that are publicly traded, and this is going to cut through all of that, and we'll now be much more liquid stock, more analysts will follow us, etc. So in the long run, it's going to be good for the firm to underprice in the short run, and especially if we come back with a seasoned offering soon. So basically think of it as a loss leader in marketing. I am going to sell, I'm going to lose money on the IPO, but I'm going to come back and make a lot of money on the secondary offering or the seasoned issue. So that's the marketing story. And I think there's a lot to it. We've seen there's evidence that, for instance, if we look at product website hits, so just I'll give you a really simple example. If Amazon went public and they underpriced, the number of people clicking on the Amazon website would go up. We have that data. We know that data, et cetera. We don't know how many it leads to sales, but I think it's pretty easy to say, well, if a lot of people are hitting on the website, some people are buying. And whether they're buying now or whether they're buying later in the year, they're going to be buying as a result. So there's probably some truth to it. I still think it's an expensive way. The second is investor marketing. And there's quite a bit of evidence that suggests that it works. That sure enough, that there's more analyst coverage a year out. There's more diverse ownership base. Shareholders are more diversified, greater liquidity, et cetera. So it does seem like it works. There's also evidence, and this is, I don't know, troubling or not. I think it's just sort of a story that has to happen, that if we go public and we are dramatically underpriced, we're going to need money sooner. So we come back with a secondary offering sooner. I'm not really sure that tells us a lot, but maybe. And I think it would tell us something, that if we come back with an IP or a seasoned equity offering soon, and we switch companies, we switch investment bankers, it might be the case that we weren't real happy with that investment banker. That idea that we mispriced it so poorly, we should switch and go to a company that's going to get a better value. And we don't see that. We do not see that. It appears that for whatever reason, that they like the idea of underpricing. They like its stock going up. And there's been some prospect theory looking at this, et cetera, behavioral story that managers, they see positive gains even though they don't see the money that they could have sold it for. So that's the marketing story. So just a real fast recap, we had 6 stories here. We had investment for underpricing, investment bankers take advantage of firms, threat of a lawsuit, market price stabilization. We'll put them both in here. Price stabilization, bribery, and probably should be a better word, but at least favoritism. mismeasurement, and marketing. So those are the 6 stories that we want to talk about quite a bit. In seasoned equity offers, what happens when you sell shares to the public? Well, generally stock prices drop. So stock prices drop on the news of a seasoned equity offer. So we see that again across countries, across time periods, et cetera, et cetera, et cetera. And it gets into the idea, I mean, if markets were perfectly efficient, we wouldn't need to see that. I think what's going on is there's some signaling. And there's a great paper. I highly, highly, highly recommend it. Smith and Masulis. Smith and Masulis. And let's just call that up, and I'll put this link in here for you. Smith and Masulis. Well, you know what? Why not? We talk about it in 402. I guess my link's the top one on this one from several years ago, but that's all right. We'll talk about it. So what they do basically is that there's 2 ways of looking at this. Increasing leverage is on this axis, so on the y-axis. So if you increase leverage, that's a good sign because you think the future is good. Good times, say debt makes good times great, bad times horrible. If you're reducing leverage, you must think that something's bad happening. So to reduce leverage, you sell common stock, you retire debt, you buy back debt early, et cetera. So all of these are negative. On the other hand, there's an implied cash flow change. This idea goes, I'm giving you, as an investor, I'm giving the firm enough money to take on all positive net present value projects. And if you come back to me, well, let me reword that. I'm giving you enough to take on all positive net present value projects if the operations do as we think they're going to. So let me give you an example from your own personal life. You go to school and your parents say, okay, here is enough money to make it through the semester if you don't waste money and you get a job. And I know how much you need. This will get through the year. This will get through the semester. That's all you need. If you come back and say, you know what? I'm buying a car and I don't need any more money. I'm just increasing my investment. They're going to think, wow, whoever, Sue, Kim, whoever is working harder is not wasting any money. That's a good thing. That's going to be a positive. If you say, okay, here's some money back. I don't need this much. At Thanksgiving time, you go back to your parents and say, you know what? I know you gave me money for the semester, but I really have too much. Here, take some back. They're going to be thrilled. Well, they are unless they think you're selling drugs, but we'll ignore that. So they're going to be happy with that. So that's going to be a positive. So anytime that we have more cash than we expected, it's a good thing. On the other hand, if you come back at Halloween time or whenever and you say, listen, I need more money, they're going to think one of 2 things. Either A, you're wasting it, or B, you're not working the hours that they thought you were going to work. So it's a negative. So here, this column, this negative column, these are all, selling debt, that's getting more debt. Selling convertible, that's getting more convertible. Common sales, selling more common. So all of these are negative because they're increasing our cash. So if you have a positive, any positive, so positive here, this is positive. So, or positive and 0. These 3 things, these that are in yellow, stock price jumps on the news, firm value jumps on the news. On the other hand, if you have a negative and a negative and a negative and a 0, stock price drops on these 3. So highly recommend, exceedingly highly recommend that you understand this table and you think about it in the sense of signaling. So I will put that in there and I will share that with you as well. So guess I'm out of time pretty much. I hope this worked. I can't guarantee it. I don't see you guys. But I hope it worked. Let me stop screening and screen sharing and see me. I hope it worked. I think it worked. Still have most of the viewers still on. I hope that you could hear me and see me, and the technology worked pretty well. Trust me, you are very glad. You do not want to catch this, whatever it is. And it was, yeah, you just don't want to catch it. Trust me. So anyways, thanks. And I will be back on in 401 in a little bit. So for Sim, thanks. Bye.